Have you noticed what's happening in the silver market right now? While most investors remain focused on headlines and short-term price swings, a much bigger story is quietly unfolding beneath the surface. Physical demand is rising, supply pressures are increasing, and the gap between silver's current price and its true value may be wider than many realize. Today, we're going to examine why a 200 silver target is no longer being dismissed by serious market analysts and why that move could arrive much sooner than most investors expect. Right now, when we talk about silver, most people still think in terms of old narratives, outdated charts, and recycled assumptions that no longer reflect the real structure of today's global supply chain. But beneath that surface level thinking, something far more important is developing, something that does not show itself in mainstream financial commentary until it is already fully in motion, and that is the accelerating structural deficit in physical silver that continues to widen year after year despite price fluctuations that try to mask the underlying imbalance. What most investors fail to understand is that silver is not just a monetary metal sitting in vaults waiting for price discovery. It is an industrial necessity embedded into the modern world, and once it is consumed in industrial processes, it is not easily recovered, recycled, or returned to the market in meaningful volumes, which means every year that demand outpaces new mine supply, the above-ground stockpiles quietly shrink. Even when the price appears stable or weak on paper, the idea that silver could move toward a 200 valuation is not based on hype or emotional forecasting. It is increasingly being discussed in terms of supply elasticity, monetary revaluation scenarios, and historical ratio corrections that occur when long-term compression in price finally breaks under the weight of physical demand. And when you analyze the data carefully, you begin to see that the conditions for such a move are not distant or theoretical, but gradually forming within the current market structure. Global mine production of silver has struggled to keep pace with demand for more than a decade, and what makes this even more significant is that a large percentage of silver output is not mined as a primary product, but rather as a byproduct of base metal mining such as copper, lead, and zinc, which means silver supply cannot simply be ramped up independently in response to rising prices, because its production is structurally tied to other industrial commodities that follow completely different economic cycles. At the same time, demand is not only persistent but expanding into new technological sectors that did not exist at scale in previous decades, including photovoltaic solar panels, electric vehicle components, advanced electronics, medical applications, and high-efficiency energy systems, each of which consumes silver in small but irreversible quantities. And when you multiply that across billions of units globally, the cumulative effect becomes enormous and increasingly difficult for mining supply to offset. The most overlooked aspect of this situation is the physical drain occurring in identifiable inventory hubs, where vaulted silver held in exchange, traded systems, and institutional storage facilities has been trending downward in ways that suggest long-term structural consumption rather than temporary market repositioning. And while paper contracts continue to trade in large volumes, the divergence between paper liquidity and physical availability continues to widen in a way that has historically preceded major price repricing events. If we step back and examine the gold to silver ratio, to one of the oldest comparative indicators in precious metals valuation, we find that it has remained at historically extreme levels for extended periods, far beyond what would normally be considered equilibrium. And in previous cycles, when such distortions reached similar magnitudes, silver did not gradually correct. It moved sharply and violently once sentiment shifted and physical demand overwhelmed available supply. Another critical factor is the role of monetary uncertainty in shaping investor behavior, because in periods where fiat confidence weakens or debt levels expand beyond sustainable thresholds, capital tends to migrate toward tangible assets with intrinsic scarcity, and silver, unlike many other commodities, sits at the intersection of monetary history and industrial necessity, giving it a dual role that becomes increasingly relevant in times of macroeconomic stress. What is often ignored in mainstream analysis is how quickly sentiment can shift once large-scale accumulation begins in physical markets. Because silver is a relatively small market compared to gold, and even modest shifts in institutional allocation or retail physical buying can create disproportionate price effects due to its limited liquidity depth, especially when supply is already constrained by years of underinvestment in new mining capacity. The investment landscape today is also influenced by growing distrust in financial instruments that do not require physical delivery. And as more participants begin to question the integrity of paper-based exposure versus actual physical ownership, the demand for allocated silver storage and direct possession begins to increase, which further reduces available free float in the market and intensifies pressure on pricing mechanisms that rely on continuous liquidity. At the same time, energy transition policies around the world are accelerating industrial consumption patterns without equivalent investment in new silver discovery projects. And because mining development cycles can take many years from exploration to production, any supply response lag becomes embedded into future deficits, meaning that even if prices were to rise today, the actual increase in physical supply would not materialize quickly enough to offset immediate demand pressures. When we consider the possibility of a 200 silver valuation, it is not a linear projection based on current price increments, but rather a reflection of what can happen when compressed ratios, supply deficits, and monetary repricing converge simultaneously, creating conditions where price discovery no longer behaves in a gradual trend, but instead accelerates through gaps where liquidity is absent historically. Markets that experience long periods of suppression followed by structural shortages do not resolve gradually. They tend to reprice in sharp expansions, because once confidence in available supply is lost, buyers begin to prioritize execution over price efficiency, and in such environments, marginal pricing becomes dominant, meaning the last available units of physical metal set the benchmark for entire valuation frameworks. The silver market today sits in a similar structural configuration, where paper supply appears abundant on the surface, but physical tightness is increasingly reported across multiple channels. And while mainstream pricing continues to reflect derivative activity, the underlying physical market operates under completely different constraints that are becoming more visible over time as industrial dependence grows and above-ground inventories continue to tighten. The system moves closer to a point where price is no longer anchored primarily by speculative sentiment, but by physical scarcity dynamics, and once that threshold is crossed, historical precedent suggests that price acceleration can become self-reinforcing, driven by fear of missing supply rather than traditional investment logic. This is why the discussion around silver is shifting from simple investment narratives towards structural revaluation scenarios, where the focus is not on whether demand exists, but on whether sufficient supply can be mobilized at any price level that maintains market balance. And that question becomes increasingly difficult to answer as consumption continues without corresponding replenishment of reserves. In this context, the 200 target is less about a prediction and more about a potential equilibrium discovery point under extreme conditions, where the system is forced to reconcile decades of underpricing with present-day industrial reality, and where the lag between perception and physical availability creates abrupt adjustments in valuation that cannot be smoothly absorbed by traditional market mechanisms. And as we move deeper into this analysis, it becomes increasingly clear that the real story is not just about price, but about the gradual tightening of a globally strategic resource that sits at the center of both technological expansion and monetary uncertainty, forming a convergence that continues to build pressure beneath the surface, gradually intensifying as more participants enter the physical market with longer-term allocation strategies and fewer willing sellers at current levels, leading into a scenario where the available float begins to thin further and further until the system itself starts reacting in ways that are no longer proportional to past cycles, and instead begin to reflect a much larger shift in how scarcity is ultimately discovered in real time within global markets, where each incremental move upward creates additional urgency among buyers who previously remained on the sidelines waiting for confirmation that may never arrive in a stable form. And this waiting dynamic itself becomes part of the feedback loop that accelerates the imbalance even further when we move into the second key structural driver behind silver's accelerating revaluation potential, We are no longer dealing with abstract financial theory or historical ratio comparisons alone. We are entering the physical reality of consumption patterns that are now expanding at a pace the mining industry has never had to accommodate before. And what makes this phase fundamentally different from previous cycles is that silver is no longer just a monetary metal waiting for investor sentiment shifts. It is now deeply embedded into the operational backbone of modern industrial civilization in a way that makes its depletion far less visible until it becomes critical. The most important misunderstanding in mainstream discourse is the assumption that industrial demand for silver is linear and predictable, when in reality it behaves more like a compounding curve driven by technological adoption, infrastructure expansion, and efficiency upgrades that continuously increase the silver intensity per unit of global output, meaning that even if individual devices use smaller amounts of silver due to miniaturization, the total global unit count is expanding so aggressively that net consumption continues to rise rather than fall. One of the most powerful forces behind this demand expansion is the global electrification trend, which is not a temporary policy phase, but a structural transition of energy systems, transportation networks, and industrial manufacturing processes. And in each of these sectors, silver plays a critical role due to its unmatched electrical conductivity, thermal efficiency, and reliability under load stress, which makes it irreplaceable in many high-performance applications despite ongoing attempts to substitute it with cheaper materials that consistently fail to match its performance characteristics at scale. In the automotive sector alone, the transition toward electric vehicles has introduced a new category of continuous silver consumption, where each vehicle requires multiple grams of silver in connectors, battery management systems, onboard electronics, and safety modules, and when these requirements are multiplied across tens of millions of units annually, the cumulative demand becomes significant enough to compete directly with traditional industrial uses that were once considered the dominant sources of silver consumption. At the same time, the solar energy industry has emerged as one of the most aggressive and consistent consumers of silver globally, particularly in photovoltaic cell production, where silver paste is used to conduct electricity generated from sunlight. And even though manufacturers have attempted to reduce silver loading per panel, the exponential expansion in solar installations has more than offset these efficiency gains, resulting in sustained upward pressure on total silver demand year after year. What is often overlooked in this discussion is that these sectors are not operating independently. They are interconnected within a broader energy transition framework that is accelerating simultaneously across multiple continents, meaning that demand surges are not isolated events, but synchronized global movements that place continuous strain on available supply chains, especially when raw material inputs like silver are sourced from a mining industry that has not significantly expanded production capacity in proportion to this demand growth. Another critical layer of industrial demand comes from the electronics and semiconductor industries, where silver is used in switches, contacts, printed circuits, and high-frequency components that require stable conductivity under increasingly complex operating conditions. And as global digitization continues to accelerate, with billions of connected devices entering the system through the Internet of Things, artificial intelligence infrastructure, and advanced communication networks, the baseline consumption of silver becomes structurally embedded into technological growth itself. Rather than being an optional input, medical applications also contribute a quietly expanding layer of demand that rarely receives attention in mainstream commodity analysis. Yet silver's antimicrobial properties make it indispensable in wound care, surgical instruments, coatings, and specialized medical devices. And as global healthcare systems expand and modernize, particularly in emerging economies, this segment continues to add steady incremental demand that is not easily reversible or cyclical in nature. The key dynamic that ties all of these sectors together is that silver demand is becoming increasingly non-discretionary, meaning that industries do not choose whether to use silver based on price alone, but based on functional necessity, performance requirements, and regulatory standards. And this shifts silver away from being a typical commodity influenced purely by substitution effects and into a category where demand becomes relatively inelastic within certain industrial thresholds. This inelasticity becomes even more important when we consider how supply responds to price signals, because unlike many commodities where higher prices quickly stimulate production increases, silver supply is constrained by geological realities and mining economics that limit how fast new production can come online, especially since a significant portion of silver is produced as a byproduct of mining for other metals, meaning its output is indirectly controlled by the economics of copper, lead, and zinc production rather than silver demand itself. As industrial demand continues to expand, we are also seeing a structural shift in how supply chains manage inventory, with manufacturers and large-scale consumers increasingly moving toward just-in-time procurement models that reduce buffer stock levels, which means that even small disruptions in physical availability can translate into immediate procurement pressure in the spot market, amplifying price sensitivity during periods of tight supply. The compounding effect of these dynamics is that silver is now experiencing demand growth not only in volume terms but also in velocity terms, where the speed at which it is being consumed and locked into long-term industrial use is increasing, and once silver enters these applications, it effectively leaves the market for extended periods, reducing available liquidity and tightening the float that is accessible for trading or investment repositioning. In parallel, global manufacturing expansion, particularly in Asia and emerging markets, continues to increase baseline industrial metal consumption across multiple sectors, and silver, as a critical enabler of modern manufacturing technologies, benefits directly from this expansion. But unlike base metals, it does not have a deep or scalable supply response mechanism that can adjust quickly to sudden demand acceleration. Another important factor is the growing emphasis on efficiency and performance optimization in industrial systems, where even marginal gains in conductivity or energy efficiency can translate into significant cost savings at scale. And because silver remains the most efficient conductor available, it continues to be selected in applications where performance cannot be compromised, even if cost considerations are rising, which reinforces its demand profile even in environments where substitution pressure exists. We also have to consider the geopolitical dimension of industrial supply chains, where countries are increasingly seeking to secure critical mineral access as part of national strategic policy, and silver is gradually being recognized as part of this critical materials framework due to its role in energy transition infrastructure, which introduces additional layers of stockpiling behavior, procurement competition, and long-term contracting that further reduces freely available market supply. As these trends converge, the silver market begins to exhibit characteristics that are not typical of conventional commodity cycles, because instead of responding primarily to price signals with predictable supply expansion, it is responding with delayed, constrained, and indirect adjustments that are insufficient to offset rapid industrial consumption growth, creating a widening gap between physical demand and available supply that becomes increasingly difficult to close over time. The psychological component of industrial demand also plays a role, because once manufacturers and supply chain managers begin to anticipate potential shortages, they tend to increase forward purchasing to secure continuity of production, and this behavior itself becomes a reinforcing mechanism that accelerates drawdowns in available inventories, even before any actual physical shortage is fully realized in the market. This creates a situation where silver demand is no longer purely reactive but increasingly anticipatory, meaning that expectations of scarcity begin to influence real consumption patterns, which then feeds back into pricing pressure, which in turn reinforces those expectations, forming a self-reinforcing loop that is characteristic of markets transitioning from equilibrium conditions into structural deficit regimes. When we integrate all of these industrial drivers together, what emerges is not a simple demand increase, but a systemic transformation in the role of silver within the global economy, where it is no longer just a tradable asset class or speculative instrument, but a foundational input into multiple high-growth sectors that define the future trajectory of technological and energy development. And this transformation continues to deepen as new applications are discovered and existing technologies become more silver-intensive in ways that are not immediately visible in short-term market data, and this hidden layer of consumption continues to accumulate beneath surface level price movements, gradually tightening the available supply base further into a condition where even marginal increases in demand begin to have amplified effects on market equilibrium, especially as the buffer between mine supply and industrial consumption narrows further with each passing production cycle. While global infrastructure buildouts continue to expand into regions that previously had minimal participation in high-tech manufacturing ecosystems, thereby adding additional layers of demand that were not historically present in earlier cycles, and as these new consumption centers mature and scale, their cumulative impact on global silver flows begins to reshape traditional assumptions about surplus and deficit thresholds, pushing the system closer toward a point where marginal buyers may begin competing directly for physical availability in ways that fundamentally alter price formation dynamics across both spot and futures markets. While the underlying production base remains structurally constrained by geological and economic limitations that prevent rapid scaling in response to these evolving pressures, leading into an increasingly compressed environment where available liquidity becomes progressively more sensitive to incremental shifts in demand that were once considered negligible but now carry disproportionate influence over short-term supply balance and long-term inventory stability.